Our focus today is Intuitive Machines, a company right at the heart of the commercial space race, operating within that really dynamic aerospace and defense sector.
That's right. And the core of our discussion today really revolves around this tension between, let's say, their grand ambition and their actual execution on the ground, or rather on the moon. Intuitive Machines has laid out this really compelling strategy. It's built on these huge long-term government contracts, all aimed at building the infrastructure for a future lunar economy.
Exactly. And so the central question we're tackling is this. Does that strategic vision, the diversification, the big contracts, does it do enough to offset the pretty significant and recurring execution failures we've seen? Not to mention the ongoing lack of profitability that makes its high market valuation seem, shall we say, questionable.
And that's where I'll be focusing. I'll be arguing that these persistent technical foul-ups and the immediate financial risks, they represent a really critical headwind. It suggests, to me at least, that the current market price is just fundamentally disconnected from what's actually happening operationally.
And I'll be making the case that these strategic wins, the big contracts, coupled with that deliberate, fast-paced diversification into potentially high-margin services, they strongly justify high-growth expectations. I see the early mission setbacks more as, necessary learning costs. They're pioneers here, and this is part of the process in a brand new frontier.
Okay, so let's hear your case first.
Right. So my position is that Intuitive Machines isn't just aiming to be some kind of lunar delivery service. No, they are strategically positioning themselves to be the foundational infrastructure layer for the whole cislunar economy. And this vision, it's built on three main pillars. First, you've got lunar access, obviously, through their landers. Second, reliable data transmission, think lunar data services. And third, broader infrastructure as a service. So the strategy isn't just about dropping off packages. It's about owning the essential communication and transport backbone for the moon.
I see the ambition, but infrastructure doesn't mean much if the tools you need to build it, if they don't work reliably. We have to look at the actual track record here.
And my argument is supported precisely by looking at the long-term revenue streams they've already secured. The big one, the standout, is the Near Space Network Services contract, NSNS. Now, this contract has a maximum potential value of, get this, $4.82 billion, and its structure is, I think, quite revolutionary for the space sector. It uses a scalable pay-by-the-minute service model. This essentially locks in a high-margin recurring revenue structure, almost like software as a service, or SaaS, but in space. That fundamentally de-risks the company from being just another capital-intensive hardware provider.
Okay.
And on top of that, the diversification is happening quickly, and it seems very deliberate. They secured an $8.2 million extension from the Air Force Research Lab to develop in-space nuclear power. They've partnered with Space Forge for manufacturing semiconductors in space. And, crucially, they acquired KinetX. That move immediately brought in vital deep space navigation technology. These aren't random side projects. They're strategic moves that go way beyond just the challenges of the lander program itself.
All right, well, that strategic diversification certainly sounds impressive on paper. I'll grant you that. But the market valuation, where the stock price sits today, feels fundamentally disconnected from the operational reality and, importantly, the current financial performance. We have to acknowledge this company is consistently posting huge operating losses. And that profit margin, minus 107%, that's not just a sign of spending big for growth. It points towards systemic unprofitability right now.
But isn't that typical for this stage?
To an extent, yes, but the execution risk remains the elephant in the room, and it's highly visible. Both the IM-1 mission and the follow-up, IM-2 Athena, both using the Nova Sea lander, tipped over shortly after touching down. Now, these weren't minor glitches. Reports suggest recurring problems with sensors, altimeters, and frankly, poor design stability. These failures directly prevented the full deployment of key payloads and the subsequent data transmission they needed to actually, make money from those missions. And when you run various intrinsic value models, the results, they suggest extreme overvaluation. Discounted cash flow estimates come in as low as $2.88, maybe $5.73 per share. That is a monumental gap compared to the market price floating around $11 or $12. And then you layer on recent concerns, the Q2 earnings miss, ongoing legal issues about fiduciary duty. It really shakes investor confidence, or it should.
Okay, let's dig into that reliability issue then. The core technology versus the contract volume.
Exactly. I see why you prioritize the big contract numbers, but let me offer a different angle on reliability. How can we possibly trust this company to deliver on multi-billion-dollar infrastructure contracts like those NSNS data relays you mentioned when the core delivery mechanism, the Nova C lander, has failed to land upright in 2 consecutive attempts? That repeating altimeter failure, it suggests a fundamental lack of maturity in the critical guidance systems. This isn't a one-off. It looks like a recurring design flaw.
That's certainly a pointed critique, though I would frame the situation quite differently. While, yes, the technical setbacks on IM1 and IM2 are critical issues, focusing only on the tipping over ignores what I see as an overwhelming, sustained vote of confidence from the U.S. government in NASA. Their continued investment, pouring money into future missions and projects, proves they view these failures as, well, manageable risks inherent in pioneering work.
But confidence doesn't guarantee success.
No, but look at the contracts they're still securing. Things like the Lunar Terrain Vehicle project, the LTV that's a major piece of future moon mobility, and that huge $719 million joint venture with KBR for NASA's satellite system. These demonstrate that NASA sees Intuitive Machines as a capable long-term partner for a sustained presence, not just some temporary one-shot contractor they'll drop after a couple of stumbles.
But don't you think that technical failure translates directly into reputational risk? That risk directly threatens the sustainability of those very government contracts you're highlighting. Partial success? Okay, yes. Landing on the moon at all is historically significant for a commercial entity, but the failures we saw were reportedly due to the exact same altimeter and navigation issues in both missions. This lack of consistency, it raises profound questions about their engineering maturity, their quality control needed to handle the sheer volume of high-stakes missions they now have on their plate, including IM3 and IM4.
I would argue, though, that they're making decisive moves to address this exact issue. They aren't just relying on their own internal, perhaps flawed systems. They're actively bringing in external expertise. That acquisition of KinetX, it specifically targeted deep space navigation know-how. It's aimed squarely at fundamentally improving landing accuracy and stability algorithms for all future missions. That shows me an ability to diagnose a weakness and then rapidly go out and acquire the solution. And moreover, the achievement still stands. They were the first U.S. commercial company to soft land on the moon, period. The IM-1 lander, even after tipping, survived for 6 days. It gathered some data. This foundational success in a totally new operating environment buys them credibility. It buys them the operational runway they need to correct the system for the next mission. We really have to remember that in this sector, just proving foundational capability is often the absolute hardest hurdle to clear.
Okay, let's shift focus slightly, maybe to the financial metrics, because you really can't separate the technical debate from the financial consequences.
Right. And I'm just not convinced by focusing solely on those negative profit margins, especially in what is clearly a capital-intensive, high-growth infrastructure phase. I mean, look, new space companies, they operate on these front-loaded investment cycles. Capital deployment way outpaces early revenue. The real question is, do they have the cash, the liquidity to actually see that cycle through?
And do they?
Well, the company maintains a pretty robust cash balance, reportedly $344.9 million as of the second quarter of 2025. That provides strong liquidity to fund these strategic investments needed to, say, activate the NSN system or develop the LTV.
I look at it a bit differently. That price-to-sales ratio, nearly 9, as I said, it signals extremely high market expectations. Expectations the company has repeatedly failed to meet, underscored by that significant Q2 earnings mess. And yes, they hold cash, but we need to ask, where is that cash coming from?
Mm-hmm.
The recent announcement of a private offering, $300 million in convertible senior notes, that's a critical signal. It points to a continuous, substantial need for capital that, upon conversion, could lead to significant future stock dilution, which directly hurts the returns for current public investors.
But surely investors are looking forward here, not just backward at the last quarter's P&L. That diversification into high-tech areas like nuclear power, and critically, that potential $4.82 billion NSNS contract that fundamentally shifts the revenue model towards that high-margin, recurring data service structure you see in SaaS. The market, I believe, rightly values this future explosive growth potential, this potential space SaaS moat. That's why you see analyst targets reaching as high as $35. You simply cannot evaluate a pioneering lunar infrastructure company using the same yardstick you'd use for a mature industrial manufacturer operating on thin hardware margins.
That's a fair challenge, I admit, but the extreme valuation discrepancy remains the primary indicator of risk here. Multiple intrinsic value models point towards overvaluation, and the wildly different estimates anywhere from under $3 to over $35, they just underscore extreme uncertainty. And that uncertainty, it's driven largely by the current unprofitability and, critically, a deeply negative book value per share, minus $3.24. Before any market valuation can truly be justified, this company has got to demonstrate operational consistency and show a credible, achievable path to actual profitability. The promise of high-margin SaaS revenue is not, in itself, a substitute for reliably delivering that service.
Okay, point taken on the need for execution. Let's talk about risk mitigation then. Is diversification the answer, or are they stretching themselves too thin?
Well, that's a compelling argument you make about the financial necessity of consistency. But have you maybe considered that pursuing so many high-risk, high-growth ventures all at the same time might actually be overstretching their operational and engineering resources? I mean, think about it. They're juggling the Nova-C lander program, developing the lunar terrain vehicle, deploying a data relay constellation, doing research into nuclear power and in-space manufacturing partnerships.
Right.
If that core competency, the Nova-C lander, remains imperfect, then all this breadth of focus could become a weakness, not a strength. Their dependence on those CLPS contracts from NASA is still massive, and if future mission failures, which aren't entirely possible, lead to shifts in government priorities, that dispersed focus could jeopardize the entire operation by fracturing attention away from perfecting the one piece of technology that underpins so much else.
See, I would argue the exact opposite. That diversification is the essential mitigation strategy against the very execution risks you're describing. If one Nova-C mission fails, which, as we've seen, can happen, the entire company's viability is not immediately jeopardized, precisely because they've established these alternative non-lunar revenue streams. Things like the Orbital Services joint venture, that AFRL nuclear power research contract. They are actively, I think, trying to transition from being just a single mission contractor totally reliant on CLPS to becoming a true resilient space infrastructure company. Their comprehensive product suite, which includes both the current Nova-C and that conceptual Nova-D lander evolution, it's necessary for the long-term goal of commercializing the moon. This is absolutely a long-term play, and that kind of ambition requires breadth of capability to ensure they have institutional resilience against the inevitable setbacks. Diversification here really acts as insurance for those mission-critical contracts.
Interesting perspective.
So, wrapping up my view, the fundamental value proposition for Intuitive Machines, it lies in the immense future scale offered by their long-term contracts in lunar access and especially data services. Yes, despite the early, highly visible technical challenges, the strategic diversification and the securing of what appears to be unwavering government support through multi-billion-dollar programs, I think validates the long-term vision of becoming the essential infrastructure provider for deep space.
And from my side, the market's clear optimism has to be tempered by two persistent realities: those negative financial metrics and the inconsistent technical execution we've discussed.
Until Intuitive Machines can demonstrate the sustained reliability of its core landing vehicle, prove it can consistently land upright and deploy its full suite of payloads, and until it provides a clear, operationalized path to consistent profitability, the stock, in my view, will remain a high-risk investment. It's plagued by uncertainty and these large valuation discrepancies. The specter of repeating mission failures looms large.